In 2023, $427 billion in capital losses were carried forward on U.S. tax returns. Most of those investors don't know they're sitting on a multi-year tax credit they can use strategically. Here's the mechanism nobody explains. Most investors think of capital losses as a one-time write-off. You sell a position at a loss, you offset some gains that year, maybe deduct $3,000 against ordinary income, and that's it. But the IRS lets you carry forward unused losses indefinitely. That means a $20,000 loss you took in 2022 can offset gains you realize in 2025, 2028, or 2035. The loss doesn't expire. It sits on your return, waiting. But here's what most people miss. You control when to use it. If you're strategic about realizing gains in years when your income is lower or when you're in a different tax bracket, that old loss becomes a planning tool. You're not just writing off a bad trade, you're creating future tax arbitrage. Let's say you took a $15,000 capital loss in 2021. You had no gains that year, so you deducted $3,000 against your W-2 income. The remaining $12,000 carries forward. In 2024, you're still working full-time in the 32% federal bracket. You have $10,000 in unrealized gains in a taxable brokerage account. You don't sell. Why? Because that $12,000 carry forward is worth more in a lower bracket. You wait until 2026 when you take a sabbatical or semi-retire. Your income drops. You're now in the 12% bracket. You sell the position, realize the $10,000 gain, and the carry forward wipes it out. You just saved 20 percentage points of federal tax on that gain by timing the offset. That's the arbitrage. Here's the specific rule. Capital losses offset capital gains dollar for dollar, regardless of holding period. Short-term losses offset short-term gains first, then long-term gains. Long-term losses offset long-term gains first, then short-term gains. After all gains are offset, you can deduct up to $3,000 per year against ordinary income. Everything beyond that rolls forward to the next tax year indefinitely. Let's work through a real scenario. January 2022, you sell a tech position at a $25,000 loss. You have no other gains that year. You deduct $3,000 against your salary. Carry forward balance, $22,000. April 2023, you realize $8,000 in short-term gains from a taxable account rebalance. The $22,000 carry forward offsets it entirely. You pay zero capital gains tax. Carry forward balance, $14,000. November 2024, you have $5,000 in long-term gains from a real estate fund distribution. The carry forward offsets it, zero tax. Carry forward balance, $9,000. You still have $9,000 sitting there. Now imagine you're planning to retire in 2026. Your income will drop from $180,000 to $60,000. You have $40,000 in unrealized gains in a taxable brokerage account. In 2025, you're still working in the 24% federal bracket plus 3.8% net investment income tax. You don't sell. In 2026, your income is $60,000. You're in the 12% bracket, and the NIIT doesn't apply. You sell the position, realize the $40,000 gain. The $9,000 carry forward offsets part of it. You pay 12% on the remaining $31,000. If you'd sold in 2025, you'd have paid 27.8% on the full $40,000. That's a $6,200 difference, directly attributable to timing the carry forward use. The loss you took in 2022 is now worth $6,200 in tax savings 3 years later. Here's the part most advisors miss. Carry forwards are most valuable when you're deliberately creating gain realization events in low-income years. This isn't about waiting for a crash. It's about manufacturing tax-free gains when your bracket drops. Scenario: you're 58, planning to retire at 60. You have $150,000 in unrealized long-term gains across several positions in a taxable account. You also have a $40,000 capital loss carry forward from a 2020 position you exited. Right now, you're earning $200,000 per year. Your marginal federal rate is 32% plus 3.8% NIIT on investment income. If you sell those positions today, you'd pay 23.8% on the full $150,000. That's $35,700 in federal tax. Instead, you wait until age 60. Your W-2 income stops. You live on cash reserves for 1 year. Your only income is $30,000 from dividends and interest. You're now in the 12% bracket. The NIIT doesn't apply because your modified adjusted gross income is below $200,000 for single filers. You start selling positions. First, $40,000 in gains, offset by the carry forward, zero tax. Next, $50,000 in gains, taxed at 0% long-term capital gains rate, because your taxable income is still under $47,025 for single filers in 2024. You've now realized $90,000 in gains and paid zero federal tax. The remaining $60,000 in gains is taxed at 15%. That's $9,000. Total federal tax, $9,000. If you'd sold everything while working, you'd have paid $35,700. You just saved $26,700 by timing the realization and using the carry forward strategically.